hello. A very good Monday to you all. Thanks once again for being here with us.
Good to be here, even if the news is rough.
Yeah, unfortunately, we are starting the week with a major conflict right at our doorstep, and this inevitably hits the markets hard. So we aren't going to waste any time today. We are going straight into the analysis.
It's the only way to handle a morning like this, really.
Today, we are going to see how armed conflicts impact different sectors, the market in general, and specifically what might happen this time around with oil. Let's get to the numbers.
And there are a lot of numbers to process today.
It is Monday, March 2nd, 2026. And I think it is safe to say we're all waking up to a radically different world than the one we left on Friday afternoon. Usually Monday morning is about, easing into the grind, checking your inbox. Today, we are drinking espresso straight from a fire hose.
It was definitely the weekend from hell for geopolitics.
That honestly feels like an understatement. We've got Operation Lion's Roar. We have Operation Epic Fury.
Those are the coordinated U.S. and Israeli airstrikes.
Right? Massive airstrikes. And the confirmation that is flashing on literally every single terminal screen right now. The death of Iranian Supreme Leader Ayatollah Ali Khamenei.
It is a massive historical pivot point. I mean, the power vacuum alone changes the calculus for the entire region. We just haven't seen a shift like this in decades.
And the market isn't waiting for the dust to settle either. We are seeing the textbook definition of a risk-off morning. For those of you who might not be glued to the futures right now, risk-off basically means money is fleeing anything speculative and just sprinting towards safety.
Exactly. When uncertainty spikes, capital hides. If you look at the futures this morning, the Dow, the S&P, the NASDAQ, they're all down over 1%.
And Asia took a beating overnight too, right?
Yeah, a significant hit. The Nikkei was down 1.4%, Hong Kong down over 2%. Everyone is pulling back.
But the big red flashing light, the thing everyone is texting me about this morning, is oil.
Oh, absolutely. Brent crude spiked 13% intraday. It hit over $82 a barrel before settling back down around 78.
And gold.
Gold is doing exactly what gold does in a crisis. We hit a historic all-time record of $5,300 an ounce.
5,300. That is just staggering. It feels like yesterday we were shocked when it crossed the 3,000 mark.
I know. But inflation fears plus war, that's the perfect storm for precious metals. It's the ultimate fear gauge for the market.
Look, our mission today isn't to be political pundits. We aren't generals. We are investors. We want to unpack what this conflict actually means for your portfolio. We need to dig into the specific mechanical risks at the Strait of Hormuz and look at the structural shift in defense stocks.
Because it's a lot more complex than just war is good for weapons.
Exactly. And we also want to see what history actually tells us about buying the dip during kinetic warfare.
There is a ton of noise right now. We need to filter it for the listener.
Let's start with the immediate pain point. Everyone is watching the gas pump. We saw that spike to $82. Now, we've seen conflicts in the Middle East for decades. Why is this specific Monday flashing red in a way we haven't seen in years?
It really comes down to three words. The Strait of Hormuz.
The eternal choke point?
It is literally the jugular vein of the global economy. This isn't just about oil fields burning somewhere. It's about transit. Roughly 20% of the world's total oil consumption passes through that tiny waterway.
20%?
Yeah, and here is the stat that people miss. 22% of global LNG, liquefied natural gas, goes through there too.
And that's absolutely critical for Europe and parts of Asia that don't have their own pipelines.
Precisely. If that gas stops moving, industrial sectors in Europe just grind to a halt. We aren't just talking about expensive gas. We were talking about no gas at all.
And the reports we're seeing today, it's not just threats anymore, is it?
No, it's not. And this is a major nuance that the general news is missing right now. The strait hasn't been legally closed by some formal naval blockade, but it is effectively blocked.
Because of the insurance markets.
They always call the shots. Lloyd's of London and the other major insurers have effectively pulled coverage for hull and machinery in that region.
And if you can't insure the ship?
You generally don't sail the ship. Not with $1 billion of cargo on board. We have reports this morning of about 170 container ships and tankers currently just anchored and waiting. Or literally reversing course in the middle of the Indian Ocean.
So the major shipping lines like Maersk, they have suspended transit entirely.
Maersk, Hapag-Lloyd, pretty much everyone.
So you basically have this massive traffic jam of global energy just sitting out there on the water.
Right, and that's the real fear driving the market. Analysts at JP Morgan and Goldman Sachs are warning that if this blockage lasts more than a month, If we move from a sharp shock to a prolonged siege, we aren't looking at $78 or $82 oil.
What are we looking at?
We are looking at $100 to $130 per barrel.
130. I mean, that is straight up recession territory.
It is, and it complicates everything for the Federal Reserve. Everyone was hoping for rate cuts later this year, to ease up a housing market, but a $10 rise in oil adds roughly 0.3 to 0.4% to headline inflation.
Just to clarify for the listener, headline inflation includes food and energy, unlike core inflation. But the Fed still has to respect it because it drives consumer expectations, right?
Exactly. If consumers see gas prices fly up to $5 or $6 a gallon, they start acting like inflation is fully back. If oil goes to 130, inflation spikes, and the Fed simply cannot cut rates. They might even have to hold them higher for longer or, heaven forbid, hike them again.
Which perfectly explains why the broader market is selling off today. It's not just a fear of missiles flying, it's the fear of sticky inflation returning and just crushing the soft landing we were promised.
Yep. And you see it right in the sector breakdown today. The energy majors, Exxon, Chevron, Shell, they are up 3 to 5% right now because the inventory they already have just got way more valuable.
But look at the airlines.
Right. Air France, IAG, they are down 5 to 8%.
Because their fuel costs just skyrocketed overnight, and half the airspace over the Middle East is closed, which forces them to fly these longer, way more expensive routes.
It's double whammy for them.
Yeah.
Massive margin compression from both sides of the ledger.
Okay, so energy is up, airlines are down. But there is another sector flashing bright green today, and that's defense. And I want to spend some time here because I feel like the narrative we usually hear is kind of lazy. It's usually just war starts by Lockheed.
Yeah, that's the cliche. And while that trade is definitely working today, Lockheed Martin is up 40% since mid-2025.
Right.
Northrop Grumman is up 46%. There is actually something much deeper going on here.
Is it just pure volume? More missiles fired equals more missiles ordered to replace them?
That's a part of it, sure. But we are witnessing a fundamental structural shift in the business model of these defense companies. Think about how we view major tech companies. Why do investors absolutely love a company like Salesforce or Microsoft?
Software as a service. It's the recurring revenue. You don't just buy the software once, you pay a subscription for it forever.
Exactly. Defense is becoming that. It's moving away from one-off sales, like just selling the Pentagon a tank or a fighter jet, to these massive long-term service contracts. The stat that really blew my mind from the research is that 70% of a weapon system's total cost is now operations and maintenance.
Wait, 70%. So the literal sticker price of the jet is only 30% of the money Lockheed eventually makes on it.
Roughly, yeah. The real money is in spare parts, it's training, and crucially, it's in software updates. If you buy an F-35 from Lockheed, you aren't just buying an airplane. You're signing up for a 30-year subscription just to keep that jet flying.
It's basically the iPhone model. The hardware is just the entry point, but the ecosystem is where the real profit is.
Exactly. And that is a huge shift in how Wall Street values these companies. Investors love predictability.
They really do. So when you see these stocks pop today, it's not just a cyclical bump because of the airstrikes this weekend.
Right. It's a recognition that the installed base of military gear is growing globally, which means that highly profitable subscription revenue is locked in for decades to come. Plus, you have to look at the Trump administration's proposed 2026 defense budget.
Which is massive this year, if I recall correctly.
Over $1.01 trillion. That's a 13.4% increase from previous baselines. And a lot of that money is going into what they are calling sovereign technology.
Things like AI, drones, cyber warfare.
Exactly. The companies that dominate those specific spaces, like Northrop with their advanced surveillance systems, they're starting to be valued like high-growth tech stocks, not just dusty old industrial metal benders.
So we have oil spiking because of the Strait of Hormuz insurance blockade and defense booming because of a structural shift to recurring revenue. It paints a picture of a very, very different economy than we had just a few years ago.
It's a harder, far more volatile world, and the market is just repricing all that risk accordingly today.
Before we get into the history side of things, because I know you have some data that might actually calm people's nerves about this morning's sell-off, I have a quick reminder for everyone tuning in.
Go for it.
If you like what you are hearing today, we invite you to subscribe to the channel, leave your like, and comment on what topics you would like us to tackle in the next deep dives. Also, in the description of this deep dive, you will find the PayPal link in case you want to support this project. Your contribution helps a lot to keep making content like this, and we only ask for the price of a coffee. Thanks for your support.
And that coffee definitely helps fuel the deep dives.
It certainly does. Okay, back to the analysis. Let's be real, it feels scary right now. The news is terrifying. The futures are deep red. The gut instinct for any normal person looking at their retirement account is to sell everything, put the cash under the mattress, and just hide. Is that the right move?
History says no. Emphatically no.
Walk me through that, because my gut is definitely screaming panic right now.
And that's totally natural. Panic is an evolutionary response. But let's actually look at the data from Bull Run Investment Management. They track market behavior during major geopolitical crises, going back to the Gulf War, 9/11, the invasion of Iraq. There's a proven pattern they call the utility short.
The utility short, bring that down for us. What does that mean?
Basically, it measures how long it is actually profitable to bet against the market during a crisis. The utility, or the actual benefit of shorting the market or panic selling, is extremely short-lived. Markets react with blind panic initially. That's the sell-off we are seeing right this minute.
Right.
But that panic creates a tactical opportunity for those who can manage to keep a cool head.
So the initial drop is usually an overreaction.
Almost always. The historical data shows that markets usually bottom out just 19 to 22 days after a war starts.
19 to 22 days, that's it. So if I sell my portfolio today, I might literally be selling at the very bottom.
It is very likely. And the recovery phase. On average, markets recover all of their initial losses within 47 days.
Less than 2 months to bounce back.
Exactly. But here is the stat that should really keep you from hitting that sell button today. In 68% of geopolitical conflicts, the broader market is actually higher 12 months later.
Higher. By how much?
The average return is plus 8.4% over that 12-month period.
That is wildly counterintuitive. You'd think war is bad for business. Uncertainty is supposed to be bad for business.
Well, war is terrible for humanity, obviously. But for the stock market, it often acts as a massive stimulus. Governments spend huge amounts of money, industries ramp up production, supply chains get rebuilt. Look at the 1990 Gulf War or the 2003 Iraq War.
You had that crazy initial volatility.
Right, the scary headlines, the red screens, but that was followed by very significant market gains as clarity returned and the stimulus hit the economy.
Okay, but is there a catch? There has to be a catch here. We can't just blindly buy the dip on every single war.
There is one big caveat to this data. This historical resilience only holds true if the war doesn't trigger a global recession.
Ah, which brings us right back to the price of oil.
Exactly. This is the trapdoor in the whole strategy. If that ship blockage in the Strait of Hormuz lasts for months and oil just sits at $130 a barrel, that effectively sucks all the oxygen out of the global economy.
Consumers stop spending because gas is too high. Shipping costs kill corporate margins.
And the Fed is forced to keep interest rates high to fight the inflation. If that exact scenario happens, the recession risk becomes the dominant story for the market, not the war itself.
So we need to be watching the strait like a hawk. If the ships start moving again, history suggests this morning's drop is a buying opportunity.
Precisely. The volatility is just the price of admission. If you sell now, you are locking in permanent losses right before the historical rebound usually begins.
Okay, so if we aren't selling, how should we be positioning? We talked about energy and defense, but what about the rest of the portfolio? Is the old 60-40 split, 60% stocks, 40% bonds, is that still the safe harbor here?
Honest answer. It's failing. The 60-40 portfolio was designed for a very specific world of low inflation. In this current environment, stocks and bonds are moving together.
The correlation is broken.
Exactly. When inflation fears spike because of a massive oil shock, bonds sell off right alongside stocks, so they aren't actually protecting you the way they used to.
So if bonds aren't the hedge anymore, what is?
Tactical asset allocation. You need real structural diversification. We are talking about gaining exposure to real assets.
Tangible things. Commodities, real estate, gold.
Gold is the ultimate hedge right now. Like we said, it's at $5,300 today. But JP Morgan projects it could realistically hit $6,300 if this Middle East conflict drags on.
So it's acting as a true safe haven.
It's not just a shiny rock. It's financial insurance against chaos and currency debasement.
What about geography? If the U.S. market is struggling with these inflation fears, where do we go? Do we look overseas?
You do have to look outside the U.S., but you have to be incredibly surgical about it. You don't want emerging markets that rely heavily on importing their oil.
Right, because countries like India or Turkey could just get absolutely crushed by these energy costs.
Exactly. You want to look at sovereign tech holders or emerging markets that are totally insulated from the energy shock.
And what about cash? Is cash trash when inflation is running hot, or is it actually useful right now?
In a moment of extreme high volatility like today, cash is actually king. Well, sort of. Not as a permanent long-term holding, obviously, but as dry powder.
Meaning you keep it ready to deploy.
Right. Keeping 6 to 12 months of liquidity allows you to do exactly what we just talked about. Calmly buy quality assets when they are severely discounted during the panic. If you are 100% fully invested right now and the market drops 10%, you can't buy the dip.
That makes total sense. It's really all about preserving optionality when everyone else is freaking out.
Precisely. So the actionable advice for the listener here is pretty clear. Don't panic sell today. Consider overweighting energy and defense because those trends are deeply structural, not just cyclical. And keep a very close eye on the 10-year Treasury yield.
Why the 10-year specifically?
Because if that yield spikes, it means the bond market is seriously worried about inflation sticking around. If it drops, it's a classic flight to safety by institutional money.
It really feels like we are in a major transition period for investing strategies overall. The old rules of just set it and forget it with a 60-40 split, they just don't seem to apply when you have advanced missiles flying over major global oil routes.
It requires way more active engagement, for sure. You have to understand the correlations in your portfolio. When the Strait of Hormuz closes, your big tech stocks might drop hard, but your defense and energy stocks should theoretically cushion that blow, if you actually have them.
Let's circle back to that defense angle for a second, because I find it fascinating. We mentioned the subscription model aspect. Is there a major risk there? I mean, if a ceasefire is signed tomorrow, which obviously we all hope for from a human perspective, do those defense stocks just crash back down to earth?
That's what we call the peace dividend risk. But you have to remember the backlog. Lockheed, Northrop, RTX, they all have absolutely massive multi-year backlogs of orders. Even if the shooting stops completely tomorrow morning, Western nations have severely depleted their own stockpiles.
Right, they've been sending gear away for years now.
And they have suddenly realized their deep vulnerabilities. So they are going to spend the next 5 to 10 years just replenishing and upgrading their base inventories.
So the fundamental floor for these stocks is just much higher than it used to be.
It's so much higher. The global geopolitical tension has effectively put a permanent put option under the entire defense sector. Governments literally cannot afford to cut that spending right now. It would be political suicide.
And what about that tech angle in defense we touched on? You mentioned AI earlier.
This is a crucial point for modern investors. The conflict we're seeing right now, the drone swarms, the automated missile intercepts, it's all run by incredibly advanced computing. The companies winning these massive Pentagon contracts aren't just the ones bending the titanium, they're the ones writing the best code.
So it's a convergence.
A total convergence of big tech and defense. So when you invest in modern defense now, you are effectively investing in a highly specialized, unregulated sector of the technology market.
That's a really great way to frame it. It's not just steel and gunpowder anymore.
Not at all. It's silicon and software.
So bringing it all back to the listener sitting at home right now, it's Monday. The news on the TV is bad. The portfolio screen is red. But the core strategy here is to hold steady, look for the structural winners, and just remember the timeline.
Correct. Panic is an emotion. It is not an investment strategy. The hard numbers tell us that the initial shock always passes. But the structural changes, like the energy transition issues and this massive defense buildup, those remain. You have to invest in the trends, not the headlines.
I love that phrase. Invest in the trends, not the headlines.
And keep watching the Strait of Hormuz, because that is the one variable that matters more than anything else right now.
We've covered a lot of ground today. The strikes, the massive oil shock, the structural boom in defense, and why history strongly suggests this volatility might actually be a buying opportunity, assuming you have the stomach for it.
It's definitely a time for strong stomachs, that's for sure.
Before we wrap up, I want to leave you, the listener, with one final thought. We spent a lot of time today talking about oil pipelines and missiles, but there is a silent winner in all of this chaos that we haven't even touched on yet.
What's that?
Supply chain resilience. Think about it. We are living in a world where the Strait of Hormuz can literally be closed overnight by actuaries in London, where the Red Sea is completely dangerous for commercial transit. The real long-term winner here might not be a defense contractor or an oil giant at all.
Oh, I see where you're going.
It might be the countries and the companies that allow you to bypass that mess entirely.
You're talking about nearshoring.
Exactly. Companies that produce locally. Nearshoring manufacturing to places like Mexico or Vietnam, places that absolutely do not rely on these fragile, incredibly dangerous choke points to get their goods to the U.S. market. They might be the true safe havens of the next decade.
That is a fascinating perspective to take. Resilience essentially becomes the most valuable asset class in the world. If your supply chain doesn't need the Strait of Hormuz, you don't really care about the blockade.
While everyone else is busy watching the Middle East, the really smart money might be quietly building automated factories in Monterey or Ho Chi Minh City. Just something for you to mull over as you watch the markets today. And with this, we reach the end of today's deep dive. We hope you liked it, learned something new, and join us for the next one.
Stay safe out there, everyone. Keep a cool head.
Thank you very much. And we'll meet again very soon. Remember, the description has the PayPal link if you want to help us out. Thanks once again. Greetings.